Hey everyone, Palo Alto Networks and CrowdStrike recently reported earnings that were on other opposite ends of the scale. Additionally, I've had several subscriber requests to compare these two cybersecurity stocks and answer which one is the better buy. So that's what I'll do in this video, compare these two on critical financial metrics, including revenue, cash flow, profitability, and valuation to determine which one I think is the better stock to buy today. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right. So the first metric I wanted to consider was revenue, and looking back, trailing 12 month for the last 10 years. And we don't really have 10 years of data for CrowdStrike, but we have a long more data for Palo Alto Networks. They've both done a great job growing revenue, 7.5 billion for Palo Alto, 2.848 billion for CrowdStrike. While Palo Alto is larger in terms of revenue, CrowdStrike is growing much faster, and that's expected to be the case again in 2024, calendar year 2024, as CrowdStrike has told investors its prospects are much better than what Palo Alto Networks told investors its prospects look like. So I would expect better revenue growth from CrowdStrike in 2024. So before I highlight the operating profit margin, I want you to understand what economies of scale means. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. Okay, so now that you've understood this metric, you can see they're both demonstrating that, but CrowdStrike more meaningfully, growing its operating profit margin from negative 60% to negative 3.27%, and Palo Alto growing from negative 10% to 7.98% positive. Now, CrowdStrike has given robust earnings per share forecast for 2024, so I would not be surprised if in the next 4 quarters, CrowdStrike's operating profit margin is positive and approaching the levels where Palo Alto is at today. So consider the cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So now that you've seen that, you can understand why these two have such high cash flow from operations, even though their operating profitabilities are so low. In this metric, they're close here, 40.68% for Palo Alto Networks and 38.37% for CrowdStrike. In fact, they're so close, I would call this metric a tie between these two, given that CrowdStrike has grown this metric more meaningfully, but Palo Alto has a higher level. So consider the average diluted shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. Okay, now that you understand the importance of shareholder dilution, you can see both of these companies are diluting shareholders. Palo Alto Networks 357 million shares outstanding when it previously had below 240 million shares in 2015, and CrowdStrike with 243 million shares outstanding where it previously had 170 million around 2019. They're both diluting shareholders. For this one, I would give the slight advantage to CrowdStrike, given that Palo Alto is more aggressively diluting shareholders in recent years. Still, they're both guilty of diluting shareholders. And finally, I wanted to look at valuation between these two, and I chose to use the forward price to earnings ratio. Given this metric, CrowdStrike is more expensive, about 50% more expensive than Palo Alto, at 68.63% compared to 45.22% for Palo Alto Networks. Now, these two, given the valuation difference, the decision was difficult for me because CrowdStrike has much better prospects for the current fiscal year. They've given robust earnings per share forecast for 2024, close to $4 in their next fiscal year in earnings per share forecasted, while Palo Alto Networks gave a more gloomy forecast for 2024, warning investors that their top line and billings growth won't be so strong as they implement a new strategy aimed at attracting customers on free trials and deals that are not going to be positive to its top line. So, given those differing outlooks and prospects for 2024 calendar year, I'm going to go with CrowdStrike as the better cybersecurity stock to buy here, although they're very close because the better prospects are offset by the more expensive valuation here. Still, I would choose CrowdStrike if I had to pick today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.